All right. Hey, just wrapped up one of our team meetings here Tuesday morning, the 16th. Really wanted to shoot this kind of, a lot of times we send this at the end of the week, but tomorrow we've got the Fed meeting for September 17th. There's no doubt we had talked about previously, they will cut rates based on the weakness of the job market. There's speculation and people going back and forth. With respect to maybe it could be a half a point cut. The reality is it'll be a quarter point cut, no doubt, and bring us to 4 to 4.25 as a rate range there for the Fed funds overnight rate. We've already seen the bond market. And again, I want to remind us of two things. One, the Fed funds rate is, the overnight lending rate. It governs short-term lending, variable rate lending, credit cards, line of credit, those kind of things. The bond market, typically the 5 and 10-year Treasury, governs more of the longer-term elements for commercial real estate loans and even the mortgage market. Now, again, what we've also seen is on the 30-year mortgage rates, they've already dropped down to 6.35% on a housing front. So again, let's take a look at what does this all mean. Okay, so interest rates, no doubt, Powell has been lambasted by Trump for the last 4 or 5 months is like cut rates. Then you see the job numbers weakening in the economy and unemployment going up. It's really showing signs that there is a greater weakness than had been perceived in the underlying economy. Powell does not want to go down on history as, having missed it and then ending up in a recession. Now, the counterbalance to that is inflation is running a bit higher than what their targeted 2% is. It's still, in that 3% range. But they also had just released about, 2-3 weeks ago, their minutes and data that's stating that they're, restating their position that they don't have to, track down to that 2% inflation rate. So that's probably going to give them a little bit more feeling of latitude of how they can move with the interest rate and not be as tied to inflation. Now, that being said, he also is concerned about it, and concerned about stickiness of inflation would not be good for the country and it would not be good for the economy. So that being said, you can anticipate tomorrow is going to be a rate cut. The bond market, is not responding to that. The bond market is responding to what they see going on with inflation and the overall economy, the softness of the job market. But I would anticipate that what we would see is in the 3 meetings ahead, we probably can count on at least 2 rate cuts. And again, it's hard to say exactly what you would know without the data that's going to be forthcoming, both on jobs and inflation before the next meetings after tomorrow. But so that's going to be an indicator as to, is it, 1 more cut or 2 more cuts? Is it a quarter point or a half point? If the job market really tanked, they probably would cut it a half point, but a half point would be aggressive today, given the numbers that we've seen. So again, we're still going to see an environment apart from, the continued softening of the economy where the interest rates are going to be cut in a slower fashion. Now, that being said, Trump's also lining up the predecessor to come for his replacement in May and, already trying to push to move the other girl out, Lisa Cook. There's a lot going on there. But again, for our purposes, we are likely to be moving into a realm of over the next 12 to 18 months that interest rates are coming down. So again, for multifamily and commercial real estate, that's a great positioning because if you're able to then buy property, whether it's stabilized or distressed, execute on the plan in the present moment, and it's an effective number that works, and then interest rates are moving down over the next, call it 18 months, and your hold cycle is, 3 to 5 years, you're going to be in an even far better position of helping boost even further your returns. Now, I wouldn't just count on it solely. That's not the best approach to it. But again, we're going to be moving into an environment where it creates great opportunity. So again, I think that this is something that is beneficial for all of us. But again, it's not something that you jump up and down like you see the stock market and expect, oh my God, it's just going to be money day one. So it's a slower process. Rates are still, as we've talked about for some time, in an elevated position. They're going to be higher for longer. And I would suggest that this decade is a more volatile interest rate environment than it was in the previous decade, where we're in a low rate environment. So, all right. Well, hey, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.